Hello friends, welcome to the Banker Zone. In this session, we will start risk and the basic risk management framework. Now see, what do you mean by the risk? Risk is the uncertainty resulting in adverse outcome, adverse in relation to the planned objective or the expectations. So what is risk? Risk is nothing but it is the uncertainty, right? It is the uncertainty which may come into picture as an adverse outcome, right, with respect to the planned objective. What do you mean by it? For example, say if you are preparing for the CAIIB examination, right, and there is a chance that you may pass the examination or you may fail the examination. So what is your objective? You are preparing for passing the CAIIB examination. If you pass, it is good. If you are not able to pass, if you are failed in the examination, that means it is the adverse outcome, that is negative output, right, with your planned objective. What is planned objective? To pass the CAIIB. Means what? The negative output is nothing but the uncertainty associated with the planned objective is nothing but the risk. So what is risk? Risk nothing but the uncertainty with respect to the planned objective. So risk would arise when the uncertainty affects adversely. So when there will be the risk, if your planned objective not getting implemented, that means the risk will be there. There will be risk. So now see, what do you mean by the financial risk? Financial risks are the uncertainty resulting in adverse variation of the profitability or outright losses. So very simple. When there is a word of finance, that means obviously we will talk about the profit or the loss. So financial risk are the uncertainty resulting in adverse variation of the profitability or outright losses. Means what? There will be the variation, right? So profit, it may decrease the profit or it may increase the losses. So decrease in the profit or increase in the losses is nothing but the financial risk. So what is a lower risk? Lower risk implies that the lower variability in net cash flow when the lower upside downside potential will be there. What do you mean by it? See, low risk, if there is a less variation in the cash flow, there will be the less risk. For example, say bank deposit. So very less variation. You are getting fixed return. However, lower upside and downside potential. What do you mean by it? For example, say if you have invested 100 rupees, right? So there may be a chance of plus or minus 10. So your value of 100 can go 110 or it can go 90. Less variation. Higher risk means what? For example, instead of the mutual fund, you have invested into the options. So higher risk would imply the higher upside and downside potential. What do you mean by it? For example, if you invested again 100 rupees, right? So there may be the chance that your value can go plus or minus 20, right? Means it can be it can go to 120 or it can go to 80 rupees. That means more upside. It can go more upside also. It can go more downside also. This is called the higher upside and downside potential. Now what do you mean by zero risk? Zero means nothing will be changed. So it implies less variation or the no variation in the net cash flow, right? So return on the zero risk investment would be the low. For example, like a bank deposit. For example, if you have invested 100 rupees, there is no risk. Definitely you are getting 10% on it. So 110 rupees you will get after maturity. That is called as the zero risk. Very simple. Zero risk means what? Very simple example. The bank deposit. No risk. Definitely you will get whatever the agreed rate there, right? So very simple. What do you mean by, I repeat, what do you mean by the financial risk? When there is a decrease in the profit or increase in the losses, simply there will be the financial risk. Lower the risk means what? Lower variation into the value, lower upside or downside value movement. Higher the risk means what? Higher will be the upside or the downside potential. Zero risk means what? There will be no variation or less variation in the cash flow. That's why the best example is bank FD, right? So this is all about the financial risk. Now see, relationship between the risk, capital and the return. Very important. See, always remember, one line you remember at least. There is a direct relationship between the risk, capital and the return. What do you mean by the risk, capital and the return? Return means what? How much you have invested and what you are getting back. That is what return. Capital means what? How much amount you are having as a backup to fight the adverse situation. And the risk means what? The uncertainty, right? So risk, capital and the return. Now see here. Higher the risk, higher is the return and higher is the capital requirement. So there is a direct relationship. Means what? If you are taking more risk, means what? Your return will be more. So you need the higher capital, right? So very simple. see, if you are preparing for the MBA examination, right? You are preparing for the MBA, right? If you have to go to the IIM, right? So you have to invest in for a better coaching classes, right? So the capital requirement, that is what the investment will be more, right? So risk will be, obviously also be more. You will pass or you will not pass. And if you pass, you will get the good package. So return will be more, right? So very simple. Higher the risk, higher will be the return, and higher will be the capital requirement, because there is a direct relationship. Now see, risk premium will be higher in case of the higher risk. So what is the risk premium? See, if you are taking more risk, obviously you will get the reward that should be high, right? If you are studying very hard, right, definitely you will pass the examination. So you are getting premium, right? So very simple. Risk premium will be higher in case of the higher risk. Lower the risk, lower will be the return, and lower will be the capital requirement. Very simple. See, there is a direct relationship between the risk, capital, and the return. If risk is less, capital requirement will be less, and obviously return on that will be less, right? So there is a direct relationship. See, in case of the financial businesses, we try to examine the risk with respect to the cash flow from the investment. Means what? How we will come to know in case of the finance, we will take into account the cash flow. How much cash is flowing into the business? How much cash is flowing out of the business? So based on that cash flow, we are able to examine the risk associated with the financial businesses. Now see, why we have to manage that risk? Basically very simple. See, risk is the basic need to be managed. Risk in a business need to be managed to limit the potential losses without affecting the business continuity. Means what? Whatever we are having, if the business is making losses, we have to control that losses, right? Secondly, we have to control the level of risk to an organization's capacity to bear the risk. That is what? That is what called. It is also called as the risk appetite. Remember. So what is your capacity to bear the risk? It is called the risk appetite. So controlling the level of risk of an organization's capacity to bear the risk means what? The risk should be within the risk appetite of the bank. That is what? Controlling of the risk. So to limit the potential losses and to control the level of risk in the organization, we are managing the risk. Okay. Now see, concept of RAROC. What is RAROC? RAROC stands for the risk adjusted return on the capital. It is the risk adjusted return on the capital. In one way, in one line, if I have to say, what is RORC? It is the return. It is a return. However, that return means what? For example, if you have invested the 100 rupees, you are getting back 110 rupees, right? So 10 rupees is what? Your return. But for that investment, you have spent 1 rupee for managing the risk. So your risk adjusted return will be 9 rupees only, right? So RAROC is nothing but only the return on the capital. Okay. Now see, RAROC is the financial metric used to measure the profitability of an investment after considering the risk. Means what? It is simply you will get to know what is your profit, right? Obviously, we will consider the risk element of it. So what is RAROC formula? Very simple. Risk adjusted expected net income. So what is your income divided with the capital required for the mitigation of that risk, absorption of that risk. It is nothing but the RAROC. Very simple. It is the risk adjusted expected net income divided with the economic capital. What is economic capital? It is the extra capital or the capital which is required apart from the normal operation to manage that risk. It is called the economic capital. Okay. So through example, you will get idea. See, consider the cash flow from the investment, say 5,000 over the period of 5 years for the given below. See, there is one investment, one for example say the bank AFD, a second investment is say in the share market. Okay, first year, second year, third year, fourth year, fifth year, continuously you are getting the 6,000 rupees the interest per year in the bank FD or in banks. Okay, so total will be 30,000 at the end of a year you are getting the interest. Now if you are invested into the share market, first year you got only 3,000, second year 9,000, third year 5,000, fourth year losses minus 2,000, fifth year very good 20,000. So total at the end of 5 year you are getting 35,000. So what you have to understand here, the investment one, the you are getting return, it is fixed. So 30,000 you are getting. So less risk is there, right? So investment two is investment in share market. So sometime you may have very good profit, sometime you may have losses. So that case is nothing but the sometimes profit, sometimes losses. So risk will be there. So more risk you have taken, right? So more the risk, so more the return. So return will be more, right? So lower risk, lower return, more risk, more return, right? Now see, investment one, steady return, steady cash flow, say 12% per annum. How? See, 6,000 you are getting on 30,000. So 12% per annum you are getting fixed. Investment 2, share market. There is no fixed cash flow. However, you are getting more than that. That is just say simply 40%, 14% per annum. So you are getting 35,000, right, on 50,000 investment. Also 40%, 14% you are getting the return. Or what I have to say, the return on investment 2, which is in a share market, for example, there is a non-steady stream of cash flow. That means variation in the cash flow. Still you are getting more rate of return because more the risk involved, more is the return. So that additional 2% what return you are getting here. See, here you are getting 12% in the first investment. Second investment you are getting 14%. That additional 2% rate of return is nothing but the risk premium or the cost of risk. So you have invested in investment 2 here where variation in the cash flow is more, risk is more, still that's why you are getting 2% more. That additional 2% you are getting is called as the risk premium or the cost of the risk. So higher the risk, higher will be the premium. Higher the risk, higher will the premium. Means what? You are taking the more risk, you will get more return. Risk in the investment is netted against the return from it. It is nothing but the RAROC. What is RAROC? Very simple. Whatever risk in the investment, it is netted against the return from it. For example, if you are getting 10% rate of return and you have to pay to get that return 2% additionally to manage the risk from that investment. So net income is what? Only 8%. That is nothing but the RAROC. What is RAROC? Very simple. I repeat, it is the risk in an investment is netted against the return from it. So whatever return you are getting, you are subtracting the risk element from it. You are getting net income after adjusting risk. That is called the RAROC, risk adjusted return on the capital. So higher the RAROC, higher will be the reward to the investor. Lower the RAROC, lower the premium, lower the capital, and lower reward. Reward means what? How much you are getting in the form of return. Okay. Now see, basic risk management framework. So see, there must be the one organization for the risk management, then the risk identification, risk measurement, risk pricing, risk monitoring and control, and the risk mitigation. So these are different steps involved into the risk management. Okay. See one by one. Risk management organization. See, risk management organization consists of the board of director. So there are basically 4 broad category here. One is the board of director. Second, we are having the risk management committee of the board. So for see, at first level, we are having board of director. Then we are having the committee of the board of director. That committee is also called as the supervisory committee of director. Third level, we are having the committee of senior level executive, also called as the subgroup, which include ALCO, that is asset liability committee, CRMC, credit risk management committee, and ORMC, that is the operational risk management committee. And at the bottom level, we are having the risk management support group. So very simple. So broadly, we are having 4 category, right? One is the board of director we are having. Secondly, we are having board of director committee. And thirdly, we are having senior level committee, which include the ALCO, then CRMC, ORMC. Then at the bottom level, we are having the support group, right? Remember that only. Very simple. We are having the board of director, then committee of a board of director, senior level committee, and the support group. This is the structure for the risk management in the organization. Okay. Now see, one by one, what is the role of board of director? First, board of director. So what is the role of a board of director in the bank? Very, very important for your exam point of view, that the board of a director has the overall responsibility for managing the risk in the bank, right? So in the examination, definitely there will be the question that managing the overall risk. So the management of the risk is overall responsibility lies with whom? Always remember, the board of a director has the overall responsibility for management of the risk in the bank. So board should decide the risk management policy of the bank and set various limit. The board articulate the risk management policy, procedure, aggregate risk limit, and they will review the mechanism and reporting and the auditing system. Right. So what board of director do? Basically, they are responsible for making the policy about the risk management. So always remember one word here. The overall responsibility of the risk always lies with the board of director. Overall responsibility of managing the risk lies with the board of director. They are mainly responsible for making the policy with respect to the risk management. Okay. Now next is the role of supervisory board of a director. So committee of a board of director. So that committee is also called as the risk management committee of the board, right? So that means what? There will be the committee, and a member of that committee will be the different director from the board of director. Okay. That committee will be setting the guideline for the risk management and reporting. That committee will ensure that the risk management process and conform to the policy. Means what? Whatever process we are having to managing the risk, it is following as per the policy, that is risk management policy. Setting up the prudential limit and the periodical review of the limit, ensuring the robustness of the risk management model, ensuring proper manning for the process. Manning means what? Proper staff must be there for the risk management. Manning means proper staff must be there, proper work, proper staff will be there, proper number of employee will be there. Manning means number of proper staff should be there. Okay, so what is the work of the risk management committee? They will set the guideline. They will ensure that whatever processes are there for the risk management, that should be in line with the policy. Then they will set different prudential limit with respect to the exposure. They will ensure the robustness of the risk management model. Means what? They are responsible for the risk management, risk measurement. So means what? Risk measurement is very important. You have to count the risk, you have to quantify the risk. So that risk measurement how to ensured by the supervisory committee of the board of director. And also they have to ensure that there must be the proper staff available for risk management. Next is the, basically that committee usually represented by the following director. So generally that committee will have what? Simply there must be the full team director like MD and ED. There can be the director from the RBI. There can be the director from the government and a 2/3 director that can be of eminence. Means what? For having some proper knowledge. In private banks, the independent director would be the member of the committee. Okay, this is additional. You don't no need to worry about this. This is just additional for your additional information. Okay. Now next is what? The ALCO. We will study the role of subgroups. So first is the ALCO. ALCO is nothing but the asset liability committee. So that basically that group oversee the liquid risk of the bank. They monitor and try to protect the and also improve the NIM. NIM is what? The net interest margin of the bank. What is net interest margin? If you are paying the on deposit say 6% and you are taking on loan say 9%, so your 3% is gap what? Between the interest paid and interest earned. That is what? Net interest income. So the management of NIM is the part of ALCO. They also recommend for the BPLR, base rate, MCLR, RLLR. Means what? The repo linked lending rate of the bank to the bond. That means the ALCO committee decide the rate of interest basically. They also monitor the treasury operation on real-time basis. Means what? For example, like a bid office group. Okay, so this is a function of ALCO. Now CRMC. CRMC is Credit Risk Management Committee. They ensure the robustness of the credit risk in the banking, including credit rating process and the model. Means what? They will overall ensure that there must be the proper credit risk management process or the models. They will conduct the portfolio analysis for a retail loan asset. They will clear any new product or a process to be put up by the business unit. That means if the company or the bank have to launch some product, right, they have to first take the approval from the CRMC. They will also calculate or they will also do the yearly rating wise distribution chart and the migration chart. What do you mean by it? Means what? If you are having different type of portfolio, how much is for the vehicle loan, how much is for the car loan, how much is for the housing loan, how much is for the credit cards. So they will prepare the chart, right? And migration means what? If there is the customer shifting from one bank to another bank, one product to another product, there are different migration charts. So basically they are preparing the MIS reports. Apart from that, yearly probability of default. What is probability of default? Means how much portfolio, how much amount of loss we can have. That is what probability of default for the individual rating as well as the average probability default. So this is basic function of the CRMC. Very simple. They are simply in one way, in one word. If I have to say what is the role of CRMC, they will manage the credit risk in the bank, right? They will do the portfolio analysis. They will clear the new credit product only. Also, they will prepare the distribution chart and the migration chart for the ease of understanding. Also, they will deal with the probability of a default. Okay. Now ORMC. That is the Operational Risk Management Committee. So ORMC, they will ensure that ensuring the robustness of the operational risk. Means what? They will be responsible for managing the operational risk. They will control the fraud. So analysis of the fraud, finding the risk mitigation measure for the non-recurrence of the fraud. Means what? Why the fraud is happening, and we will ensure that it will not repeated. Clear any new product or the processes other than the credit put up by the business unit. So if there are new product launched by the bank, then the ORMC will give the approval, right? But for credit, we have to take the permission from CRMC only. Okay, now lastly, at the bottom level, we are having the risk management support group, or the department. So basically, risk management department will be headed by the CRO, that is Chief Risk Officer. So Chief Risk Officer should be at a level of a general manager in the public sector bank, not less than that. So Chief Risk Officer will be assisted by the different qualified and well-educated skilled staff to manage the department. So first is the asset liability group. So that a group basically look into the market risk. It may be the liquidity, interest rate, or the forex, right? Asset liability group. Then we are having the mid office group, that is mainly to monitor the treasury operation. So to mitigate the risk in treasury, we are having mid office group. Then we are having the credit risk group. So that basically to monitor the credit risk, and we are having operational risk group to monitor the operational and the residual risk. Okay. So these are the different groups under the at a bottom level we are having, right? That is asset liability group, mid office group, credit risk group, and the operational risk group. Okay. Now see, if we have to manage the risk in the bank, we are having three business lines, right? So banking business line can be grouped into the three category with respect to the risk management. One is the banking book, second is the trading book, and third is the balance sheet exposure. So banking book means simply it includes your all the advances you are given, the deposits you are taken, or borrowing, right, from RBI or other bank. That is what simply the banking operation. With respect to the trading book, trading means obviously it includes the investment only, right? So asset in a marketable security. They are not held till maturity. Means what? We are doing it trading, means purchasing and selling. So we will not hold it for the maturity. So mark to market system is followed in their accounting. What do you mean by mark to market? Mark to market means what? See, if the current market price is 100, right? And if you have purchased at the book value, say 80 rupees, right? So 20 rupees you are having today profit. So that 20 rupees we will take into account as a profit, right? So if you have purchased at 80 rupees, now current value is 60, so you are having minus 20. So you have to take the into profit and loss account that minus 20. That is what the market price and the book value difference we will take into account profit and loss. That is what the mark to market basis. Now off balance sheet exposure, it includes the letter of credit, guarantee, derivative like a swap, future, forward contract, option, etc. Right? Very simple. What is off balance sheet exposure? For example, the bank has taken some guarantee, right? That if customer does not repay, for example, 10 lakh bank have to pay. So that 10 lakh is not immediately liability for the bank. The bit may crystallizes in future, right? That is what the off balance sheet exposure, right? Very simple. For risk management perspective, we are having three business line in the bank. One is the banking book, trading book, and the off balance sheet exposure. Okay. Now see, what are the steps involved into the risk management in the bank? Very, very important. Okay. First is the risk management, risk measurement, risk pricing, risk monitoring and control, and the risk mitigation. So these are the 5 steps into the risk management. Very, very important. Remember, first we need to identify what is the risk. Then after identification, we will measure, that is quantify the risk. Then we will do the risk pricing, what amount of investment we should do to mitigate that risk. Then we will monitor and control the risk, and at the end of the day we have to mitigate that risk, right? So these are the steps involved into the risk management. Okay, first is the risk identification. See, risk identification involve identifying various risks associated with the risk taking at the transaction level and examining the impact on portfolio and the capital requirement. What do you mean by it? See here. Now see, risk identification. What do you mean by risk identification? For example, if you are doing the transaction, like if you have taken the deposit from the customer and you have lended it as an advance. Okay. Now deposit and lending. So this is the transaction of the bank. Now see, giving loan to a customer, what is the capital additionally you need to insure, right? Then what is the impact of portfolio and the capital requirement? For example, if you have given the loan of say 10 CR, if it is unsecured, how much capital you need to make sure that will absorb the losses, right? So very simple. What is risk identification means? We have to identify the various risk. See, very name is indicating. Risk identification means we will identify the risk associated with the transaction and how it will impact the portfolio of the bank and what is the capital requirement for that risk. That is what simply the risk identification. Okay, through example you will get the idea how we have to identify the risk. See, there is SBI branch and which has sanctioned a loan of say 1 CR to a company as per the policy of SBI. The loan is sanctioned for 8 years additional 1 year will be the moratorium. What is moratorium? Means the period after sanctioning the loan where we will not recover the money. That is what? That is a sleeping period. Now rate of interest is 11% for that loan. So for 8 years you are given the loan, right? And at 11% rate of interest is there. And funding the loan has been made from the term deposit of a 5 years, same amount taken at 7% rate of interest. So on what basis we have given the loan? We are having for a 5 years the term deposit with us, right? And the rate of interest for the term deposit is 7%. Okay, and this is the loan. Okay, now this is a very simple example. Now see, funding risk. So what are the risks associated with this transaction? So loan is given for 8 years and deposit we are having only for the 5 years, right? So 3 years is the gap, right? So deposit maturity is 5 year, loan period is 8 year. So remaining period of loan, so that 3 years gap, how will source that loan, right? So source to fund the balance of a loan has to be arranged. That is what? The funding risk. So after 5 years, suppose after 5 years, we will repay the deposit to the customer. So how we will survive for the remaining 3 years, right? So that is what the funding risk. Then we are having the liquid risk. When there is a maturity mismatch in the transaction, obviously we will face the liquid risk. So deposit for a 5 year, loan is for 8 year, maturity mismatch, so liquid risk. Time risk means what? If the loan repayment is not made regularly in a time, there will be the time risk. That means the repayment is not coming in time, there will be a time risk like EMI bounce. Basis risk means simply, see, loan is linked to the MCLR. For example, loan is given for 8 year, rate of interest is 11%, which is linked to the MCLR. Okay, now MCLR may change during the period, but term deposit is having fixed rate. So that income to the bank, right? The 11% that can change due to the linkage with the MCLR. Loan is linked with the MCLR. So after some time, say after 6 months, the MCLR has been reduced and now loan becomes say 8% only. So still bank has to pay 7% to the term deposit. Means what? The net interest income of the bank will decrease, right? So that is nothing but the basis risk. So if MCLR is reduced in this period, there will be the losses on account of the basis risk. It is all basis risk. Very simple, right? Now next is what? The gap or the mismatch risk. See, gap between the maturity and the interest rate reset date, that is asset and liability. For example, say after 5 years, when the funding of a balance amount of the loan to be made, the deposit rate may not be the same. Means what? See, if you are having 5 year for the 5 year deposit, right? So after 5 years, you are having loan for 8 years. So after 5 years, you have to repay it back to the customer. After 5 years, there may be the chance that the rate of interest for the fixed deposit have been increased. So you have to pay more to the deposit, right? That is called the gap or the mismatch risk. That is mainly, see, one word is there. For gap or mismatch, you remember only one word. The interest rate reset date. That means after maturity, you have to take the new deposit. That's why the interest rate will be reset. Reinvestment risk means simply when the bank gets loan for loan early repayment. For example, we have given loan for 5 years, but before end of 5 years, the bank gets early repayment. So it may have to invest the fund somewhere else. That's, for example, customer has done the early repayment. So our loan money we got back. So that loan money we got back. So we have to lend it again somewhere else. That is called the reinvestment risk. Embedded option, very simple. If customer withdraws its deposit by the customer before the end of 5 years, that means the maturity for the deposit is 5 years, but before that customer want to withdraw the deposit, that time bank will face the embedded option risk. That means the withdrawal of deposit simply is the embedded option risk. Credit or default risk, very simple. If customer default to make the repayment, that means customer is not doing the repayment, we are having the default of the credit risk. Then operational risk means what? If there is any fraud on the part of the borrower, or if the bank staff committed some fraud, or if some documentation problem is there, then we have to say it is the operational risk. Very simple, right? So friends, this is the first part of this lecture. You can download the application. We are having a Bankers Zone CAIIB application. You can download it from the Play Store. This is the Android application where you will get the full courses. Thank you, friends.